Ready?
Yeah, go ahead. No, we're
What's
good.
he doing?
No, it's fine. Let's
That was great. That's a technology conference, so they're good at this stuff.
Okay.
So you are going to be hearing from Gregory Karsh and Sasha Hodder, which are attorneys, like I said, from Florida, who are very knowledgeable on the following topics. So I think we'll start with Greg, right?
Okay, hello everybody. I'll give you just a little background on myself here. I'm an attorney here in Tampa, Florida. I've been in the blockchain space since 2013, 2014. When I originally did a public policy, which was published and got me sort of hooked on the blockchain and cryptocurrency. So I've been practicing and studying in the space and we represent primarily crypto and blockchain companies now. We're business lawyers, we're business startup lawyers. We do a lot of business finance, business setup, organization, structure, and those types of things. So that's kind of where our practice is. And over the last year or two, that become our sole practice, just blockchain and cryptocurrency business. So I'll let Sasha do an intro now.
Thank you. Yeah, my name's Sasha Hodder. I've been working with Greg at World Block Legal since January, and things have been very exciting. You know, in the crypto space, everything's moving so quickly. We've taken on a lot of new clients, people working on ICOs or looking at the money transmission laws. And so I guess I should reframe. When I say ICOs, I mean we do them through the traditional securities laws, so private placements. And yeah, any kind of crypto or blockchain project is what we focus on. My background before becoming an attorney was in investment sales with some big mutual fund companies in Canada, as well. I was a Series 7 licensed trader with TD Ameritrade. So got to kind of understand the finance market that way and really enjoying the cryptocurrency market so far.
What I wanted to just briefly touch on and talk about a little bit is we hear a lot about the ICOs and money being raised in ICOs and the issues with whether those tokens that are being sold are securities or not. Sasha's going to touch a little bit more on the securities aspect, how you can believe securities and all of those things. But what I wanted to touch on is something a little bit different that people don't talk a great deal about, which is when you go out and you raise substantial amounts of money up front before you've started a business like people are doing in these ICOs, and you raise, say, you sell 40% of your tokens and $20 that, and you have basically taken on a substantial responsibility without having built a company where, because you sold 40% of those tokens, you're in essence have valued your company at $50 million, and you haven't even built anything yet. And so you've got, startups are difficult, and most startups even succeed, and even fewer become $50 million companies. And so people are concerned about securities laws, and they don't want to violate securities laws. They go overseas and raise the money. They do all these things to try to raise the money up front before they build the business. And what I wanted to highlight is the risk in that, because you've invested money into your startup, you're raising all of that money up front in more like an IPO, which is more of an exit strategy than a startup strategy. And you've taken on responsibility, and those investors are going to have expectations that you're going to build a business that's going to be worth what they've invested in. And so there's in a lot of ways, there's risk that it's not the SEC that's going to come get you, but plaintiffs' lawyers may come after you in the next several years if you haven't been able to build this business. Even if it's not your fault, or even if it wasn't fraudulent to begin with, that's going to, plaintiff's lawyers can be unrelenting. And so you're really putting yourself at risk by taking this approach. You know, the REITs are funded in a measured sort of series of funding rounds as a startup develops. There's advantages to the startup in that it protects the founders of the startup from getting too much liability before they know whether their company's going to be a viable company or not. I would caution you. And then, of course, the state regulators, they're starting to come out, and we heard a lot about that in the press in the last few weeks, where there's a whole series of actions being taken against these companies from a state regulatory perspective. Well, it's also very bad. But I think it's really important to understand that risk and the fiduciary obligations that you have to the token holders. It's very similar to what you would have to shareholders or other owners of a company, because you're going to develop and you're going to give them some return on their investment. So that was something I wanted to point out, that I don't think that people often go about these laws and the way we do things are designed to protect founders as well. So I'll let Sasha talk a little bit about the regulations, and then we can take some questions and that.
Thank you. Yeah, I wanted to highlight some of the ways that you can raise money that is still SEC compliant. So, the typical way we've done the cryptocurrency ICOs over the past year just involved, selling some Ethereum, bringing in some, money in exchange for the tokens, and away we go. There was no KYC information collected, and it was a really straightforward, easy process, and it was fun for those investing and for those getting the money coming in. But since the DAO last summer, the SEC has been putting a lot of pressure on the whole industry. And so I just think now it's not prudent to do an ICO without following the regulations. And so there's a couple ways you can do it. If you're an issuer or a crypto company starting up, you can follow Regulation D 506C. And that allows you to raise an unlimited amount of money from accredited investors. And an accredited investor is someone who has $1 million of net worth or an income of $200,000 over the last 2 years, with the expectation to continue. So it kind of limits a big scope of the cryptocurrency audience that maybe didn't, early adopt Bitcoin and get that net worth of $1 million. But it allows you to raise money the way any other company is set up. And the idea behind it is that the people investing can take on the risk or understand the risk of what they're purchasing. And then the other option that you can do in conjunction with your Regulation D is called Regulation CF. It's a part of the Jobs Act, and it allows you to raise $1.07 million from non-accredited investors. So both scenarios, though, have a major drawback that you can't trade the tokens for a year after issuing them. So they're not, it's the best that's available to be compliant, but it's certainly not as easy as if you just did it without following any regulations. And then there's another regulation called Regulation S that allows you to access the foreign market, and it's different if you do the sales overseas. So if you're an American company and you take e-residency in somewhere like Estonia, you still have to follow Regulation S, because there's a large probability that the tokens, once sold, will flow back into the American market. They break it down into 3 tiers as to who has, there's a shorter time frame for tier 1 and 2, but if there's a high probability that tokens will flow back into America, which I think, us Americans, well, I'm not even American, I just live here, but we love cryptocurrency, and the appetite is pretty high here compared to the rest of the world. So so Regulation S, you're still supposed to follow that Rule 144, which is what requires the 1-year lockup period. I think what we're going to see in the next year or so is a lot of exchanges becoming compliant with this so that accredited investors will have a way to trade these locked, or I call them locked, but they're just, you can still trade them with accredited investors during that time. So there might be these markets that spring up that cater to that and at least can create some liquidity for the token price. The whole thing creates a big mess too, because people want to get their token moving and get a price set, and they want to either airdrop things while they're doing this 1-year lockup, but none of that, I always hate being the bearer of bad news to clients, because it's pretty restrictive to follow the SEC's guidelines. But it can be done. Were you guys going to ask some questions?
I guess we can. We want to open it up for some questions, or we could probably find more things to talk about. There's plenty to talk about.
So
Okay.
Here you go.
Hi, thanks a lot. I wanted to find out about utility tokens. For utility tokens that are actually usable thing, that are a service that's already there or going to be there in the next week or so. How are those different than securities, and how can they be sold? Thanks.
I didn't hear the question very well.
All right, well, let's try that one more time because it's a really good question.
Try to get close to okay, I wanted to find out about utility tokens as opposed to securities. So tokens that you can sell that already exist, or for something that already exists, but you want to tokenize it and be able to offer that instead of the security, providing some sort of return at the secondary.
Okay, I think I understand the question. The idea, the question is if you've got an existing business or existing services and a token, is that still security, or is that something different? Is that do I understand the question?
He was asking about a utility token.
Like a utility versus a security token?
Mm-hmm.
Correct.
Okay. For me, that's not an easy answer right now because we haven't gotten very much clarity. So the way that things have been developing so far is the SEC has jurisdiction as to whether a token is a security or not. So they either determine it's a security or they determine it's not. They use the Howey test, which everybody's heard about probably. And so what it boils down to is if you're raising funds to develop your token and you haven't developed the token yet and it's not functional, it's not being used right now, you're more than likely going to fall into the security, but it's the facts and circumstances, and we could never answer a particular question about a particular token without looking at it. But that's just the general gist of it. And so the question then becomes, so if it's not a security, if SEC decides it's security, then what do we do with it? And nobody's defining that yet because nobody necessarily has jurisdiction over that. The SEC's jurisdiction is if it's a security, and then they take over the regulation of that. But they haven't really offered a definition so much of what a utility token would be, other than it's not a security. And then if the CFTC decides it's a commodity, then that gives us some clarity. But we don't ever get to the point of what exactly is a utility token yet. So I think that's to be still. Congress probably have to develop that on a federal level, or the states will have to come out with. Wyoming has come out with some guidance as to what a utility token would be, but that's only in Wyoming, so that's not widely applicable. I don't know if that helps, but that's my sense of where we are with that question.
Yeah, maybe I can answer it too.
Sorry about that.
Wyoming, so they created a utility token, the first one out there that defines it. And if your company is registered in Wyoming, which they have amazing laws, like that bill that got passed has 5 other pieces to it where there's no state taxes, you can remain anonymous. There's a lot of, it's very crypto friendly over there. and the team is working really hard to keep developing. So the next thing that they're coming out with is a way that the LLC that wants to issue the utility token can create some kind of parent company where people can basically come into it as e-residents. So even if you're not living in Wyoming, you join this LLC that's issuing the utility token, and then you can participate in it without being an accredited investor or following any of the SEC's private placement guidelines, because this thing is not a security and not in their jurisdiction. It's yet to be tested. So, the SEC could come out and just say, like, no, we still have jurisdiction, but that'll have to be a battle that Wyoming will probably defend pretty hard against based on how they've been handling everything so far. And then on the other side, like I've seen a lot of games coming up, or the art trading cards, rare Pepes, Bitcoins. There's a lot of counterparty tokens that are considered utility tokens. And I think it's, as Greg said, it's a fact by fact analysis. So if there's something where it's got a game type nature that all the users are contributing to the success of the coin, then that can kind of bring it out of that last Howie prong that the price is dependent on the efforts of a third party. So there's little nuances here and there. And as he said, it would have to be a fact by fact basis, but you have to go through the Howie 4 prongs and find out, if there's any, where you actually sit on all of it. And the nature that these can go up in value is a big factor that bring it into the security zone. But it's not the only factor to look at.
Thank you. I have a question. Can you hear me? Okay, great. So is there any inclination or any signaling from the SEC or the CFTC? There is a desire to build a comprehensive regulatory framework controlling cryptocurrencies and the utilization of this technology? Because right now it seems very like nobody's working together is how I feel as an attorney looking at this problem.
Yeah, I would say that I think that there very much is. I think Congress is doing things where the SEC and the CFTC and others come into Congress and they have hearings and talk about what needs to happen. They're in the very early stages of that. But there's also a lot of, we hear a lot about private meetings with the SEC. A lot of attorneys, a lot of people from Coin Center who's in DC, and they're pretty active in trying to persuade policymakers as to how to proceed in the case. And there's a lot of private meetings among the companies that are involved and things like that with the regulators. And I think they're developing this sort of, they're still trying to learn as much as they can about it seems. But I do think that there's a general sense that there's going to need to be some comprehensive regulation. Partly because, as I mentioned earlier, the SEC's jurisdiction stops if it's not a security. And so then it has to be picked up elsewhere. And so that disjointedness probably results in some comprehensive regulation or law, but that's likely to have to come from Congress, and that's likely to be a year or two away the way Congress operates. So it's not imminent, but I think they're working on trying to figure out what they need to do to regulate the space a little better.
And I know there's a lot of attorneys that are with the Brooklyn Project out of New York that are every day they're drafting new things, looking at how it should be regulated. So there's a lot of thought leadership in that area coming out. Well, some of the stuff, there's a lot of debate on how it it's a Telegram chat called the Brooklyn Project, and there's over 1,000 people. Many of them are attorneys, and it's a very lively chat in there because no one can agree on how it should be done. And maybe the fact that it's not been regulated or not been put a guideline on is the SEC, or, if you get into the conspiracy theory side, or, that kind of mentality that they don't want Bitcoin to succeed or to replace the banks. Maybe that's why there's no exact regulation coming out, because iffy gray area puts it so that they can control everything that we're doing in the token side. Whereas if there was a distinct regulation, then it would be very clear and people would know how to move forward accordingly. So I think that could possibly be part of why there hasn't been any direct regulation. Maybe that's way off base though.
Anybody else have any questions? Oh, we have another question. Can you come over here? It's okay. I can try. So we have a question. One of the questions is there any other states that are actively working on similar models like Wyoming, or maybe a different model to address and be on the forefront of this? And what can a state like Montana do to I guess, a welcoming or sort of words with states?
Well, I know Colorado recently had a hearing trying to pass the same utility token bill, and it didn't go through. So they were trying, but I don't know if it just got delayed or if it got stopped entirely. But I would suggest anyone that's interested in trying to pursue this, come to the Wyoming Coalition Telegram chat and get in touch with Caitlin Long, a guy named Tony Rose, and a guy named Richard. They're kind of the three that were instrumental in getting it passed in Wyoming, and they are so eager to help other states. So, they'll give you all the documents that they used and presented to their state, and basically support you the whole way through. And I kind of think Florida, maybe Greg and I, we should get a group of attorneys together to try there. But they recently allowed people to pay their taxes with Bitcoin. So it seems like they've.
Yeah, there's the county down here in Florida where the county has said and then the legislature down here in Florida introduced a bill just to see how it would go that recognizes blockchain and recognizes smart contracts in the state of Florida. So they're aware of it. They're not really doing that much like Wyoming is. Wyoming is certainly the leader in that space. But blockchain, Delaware has the Delaware Blockchain Initiative, and they've been doing that for even before Wyoming. They started that. The government there, but very limited in what they've done. They've acknowledged that stocks can be tracked on the blockchain, and they've got that into their statute. And they also allow for UCC filings on the blockchain. And so they've had a few initiatives, but they haven't really followed through in as comprehensive a way, I think, as Wyoming. But I suspect that's coming shortly. So I'm sure that they're going to follow suit here pretty quickly, I would imagine.
And I think, I could be wrong, but I think Montana has a really good money transmission law. Do you know about, is anyone familiar?
Yeah, I don't think they have one. So yeah, I think it's the only state that doesn't have a money transmission law.
Mm-hmm. You can run a Bitcoin ATM or something like that without as much hassle, or an exchange for that matter. Yeah,
within the state, yeah. But just like with Wyoming, it's only as good as they're operating within the state. So it's a great initiative, but it's not in Wyoming. But it's a good model to start from, for sure.
That was a good question. Anybody else? I think we're going to let you guys get back to the hard work you're doing.
All right, good. Thanks for having us. We're, it's a fun space.
Thank you. Have a good rest of the conference. We wish we were there in person.
Yeah, it would have been way better to be there in person, but.
Say hi to Daryl and Mike if you see them around.
Yeah.
This was so much.
All right,
really
you're welcome.
Well, that was cool.